Hi, I'm Erik Schatzker, here in the Bay Area talking to author Michael Lewis, the man behind Liar's Poker, Moneyball, and The Blind Side. For his newest book, The Big Short, Michael spent a year in hedge fund land, looking for the small handful of people who anticipated the subprime mortgage collapse. He wanted to know why they spotted the catastrophic bubble that everyone else missed.
This is one of the great mysteries of the last few years in finance. There emerges on the scene this really, really smart trade, buying credit default swaps on subprime mortgage bonds. Very limited downside, you're buying insurance on subprime mortgage bonds. Limited downside, you're paying a couple of % premium a year for a bet that, you know, maybe it's not sure to pay out, but the odds are better than 50 to 1 that they will. I mean, it's a really obvious smart bet. And many thousands of investors could have made this bet. Not individual investors, for the most part, but a lot of institutional investors could have made this bet. In the end, only about a dozen make it in a huge way. Most of them are outsiders, are people who are kind of on the fringe of, certainly on the fringe of the credit markets. They're not people who are bond market people. They're people who, they were, for the most part, stock market people, sort of crawfished into it because they could see that the stocks that they were trying to understand were going to be driven by this event that was going on in the subprime mortgage market, so they had to understand the subprime mortgage market. And then the more they came to understand it, the more appalled they were by how that market worked. And the more appalled they became, the more they began to think, well, I really ought to bet against it. In each case, I mean, I learned something about investing from this book, because I've always thought of it as kind of an antiseptic event, and it's kind of a purely intellectual event. And it was pretty clear to me in each case these characters had an emotional and slash sort of psychological dimension to them that enabled them to get where they are.
You note early on in the book that John Paulson made more money than anyone had ever made so quickly on Wall Street. So why not make him more part of the story?
I spent time with him, and he was very friendly. I mean, I could have made him part of the story very easily. But I had a purpose for this story, and the purpose was I wanted to explain to the reader what on earth had happened. And to do that, it helped that the characters themselves had to learn about these markets, that they didn't understand these markets to begin with. So the reader could learn with them. John Paulson happened to be just oddly positioned inside the financial markets, in that he was one of the few people who made his living shorting bonds and looking for bonds to short. And he was also, his motives were, to me, less interesting. He's much more a purely economic animal. And so he didn't have a great distance to travel to get to the trade. The people who I was interested in were the people who had kind of laid it all on the line, where they had started out thinking, yeah, nice little trade, and they'd ended up essentially, if this didn't work out, their careers were over. And Paulson had very cleverly, but from the characterological point of view, less interestingly, structured his financial life so that he was going to kind of win either way.
They're not protagonists, but you do identify some of the people on Wall Street who figured out the subprime bubble early. Greg Lippman from Deutsche Bank, for example, Gene Park at AIG Financial Products. I'm curious, why no central character from Goldman Sachs? Because it was Goldman that created the synthetic CDO in the first place.
That's right. I mean, Goldman's in the book in a big way. I suppose if they would have let me speak honestly to Jonathan Egal, the trader there, or Andy Dalvelman, the salesman who sold the credit default bought credit default swaps from the AIG, but put AIG into the subprime mortgage market, I might have developed them further as characters. But Goldman, the last thing they want is someone like me writing about Goldman Sachs. They're very careful about what they'll divulge. The people inside the Wall Street firms who were more interesting to me were the people who had first tried to seen the opportunity, and there weren't many. I mean, Greg Lippman is the exception. Goldman Sachs was shrewd in finding AIG to be the turkey at the table, and shrewd in getting them to insure subprime mortgage bonds. But Goldman Sachs was not set up at the when they're doing that to make money if the subprime mortgage bond market collapsed. If the subprime mortgage bond market had done what it was supposed to do and collapsed maybe a year or a year and a half earlier than it did, Goldman would have been buried. They were long. So they were the dumb money too, so they weren't that interesting for that reason. The one guy who was really interesting as kind of smart money inside a Wall Street firm was Greg Lippmann. I mean, Lippmann was a Deutsche Bank subprime asset-backed trader who was at war with his own firm because the whole rest of the firm is long the market, and he's saying this is going to be disaster. And Lippmann was the proselytizer of the trade. I mean, the bond market is the Wild West. What goes on in the bond market would never be allowed to go on in the stock market. Investors in the bond market know that if Goldman Sachs or Deutsche Bank comes and wants to sell you something, you don't want to buy it. And so that Greg Lippmann is running around selling the single greatest trade in the history of the bond market, and nobody believes him. It tells you something about the bond market. He can't get the message across because where he comes from. Then the other, broadly speaking, character on Wall Street who was interesting to me was who was in a big way the dumb money on the other side. Nowhere else on Wall Street was there a single trader, I don't think, who making a directional bet on the subprime mortgage market who lost as much as Howie Hubler did at Morgan Stanley. He lost $9.4 billion. Now, I don't think anybody's ever done that on Wall Street, and that this guy had done it, and he was basically anonymous, was amazing to me.
Michael Lewis says it's just wrong how a single Wall Street firm could do so much to fuel the subprime bubble. Find out which one when we come back. When it comes to picking the biggest villain in the mortgage meltdown, there's a lot to choose from. Michael Lewis narrows it down to one firm.
If I had put my finger on one person or one kind of person, one role player in this crisis who I would like to string up, or rather I'd like to have him just have to answer questions honestly to the public, I think it would be the people who I know knew better. I would like for the people who designed synthetic CDOs at Goldman Sachs and persuaded AIG to insure them, to essentially take all the risk in the subprime mortgage market in 2005. I would like for them to explain what they thought they were doing. There was nothing illegal about what they did. It was just exploitative. It was just wrong. But they were smart enough, and their position in the society was elevated enough that you would have thought that they would have paused and said, I have some responsibility here not to do this or to prevent this from happening, not to actually make it happen. So I hold there's a very obvious status structure on Wall Street. The ratings agencies aren't even in it, but at the very top of the status structure is Goldman Sachs, certain traders at Goldman Sachs, and hedge funds. And when the people at the top set such a bad example, everything else in a weird way follows from it. And I'd like the genuine elites to explain why they behaved in the way they did, because I think in the end, if you're going to get back to a saner relationship between our financial system and the rest of the economy, the rest of the society, you have to have people at the very top of that structure who have some sense of social obligation, and they don't right now. And it's a question of kind of how do you restore that? I think you restore it with shame, with a sense of you should be ashamed that you did not behave in the way you should have behaved.
Does that make Goldman evil?
Evil's too strong a word. I think the system is evil, and the system is now obviously capable of, and likely to do great wrong. And the rules in the system need to be changed. I mean, one of the things I learned writing the book, and it just reinforced what I always suspected, was how amazingly powerful incentives are, and you just can't ignore them. And you've got to be very careful about the incentives that you give people. And people are just badly incentivized, and they're badly incentivized inside Goldman Sachs. and I'm sure individually they're all great. You know, they're all smart. I'm sure they're
in some cases delightful.
Absolutely. Maybe not at the end of their careers, but certainly the beginning. And so it's not that these are bad people. And it's a mistake to say, oh, what you need to do is get rid of some bad people and put some good people in. Because if you put the good people into the same system, they'll become bad people. They're badly incentivized.
So what happens, though, if the rules of the game aren't changed?
The popular thing to say is, oh, it's all going to happen again. But if it does happen, all happen again, it's going to happen in such a different way. It's going to require an elaborate explanation to show people how it all connects up. But it will all happen again. And but the bigger problem is, what is Wall Street supposed to do? It's supposed to. It is not a creator of wealth. It is a handmaiden to creators of wealth. It occupies a essentially parasitic, but usefully parasitic, relationship with the rest of the society. It's totally out of control. It is not making America a great place. It's making America a worse place right now. And so that's the problem. That finance needs to occupy a healthier, more productive relationship with the rest of the society. And it isn't just an economic relationship. It's got this social cultural component to it. That it is not healthy that our financial system has rules in it that enable the returns to individual traders that it enables, and that leads, half the smartest kids from the best schools wanting to be more than anything else in their lives bond traders or investment bankers. It's a waste of talent. The wrong economic signals are being sent by the system that's in place. That I think if the rules were changed and it was in some obvious ways, the returns to the finance sector would decline, and the talent would find more useful avenues of endeavor.
Michael Lewis knows as much about trader psychology as any author, but even he was surprised at what he learned writing The Big Short. We'll have that when we come back. Writing The Big Short, Michael Lewis got close to the most toxic trades in history. They taught him something critical and frightening about the culture of Wall Street.
In the Wall Street firms, I should have known it, but I didn't know it. I didn't know quite how cynical they could become, and just how detached from their original purpose they could get. And this surprised me because the Salomon Brothers I left in 1989 was a fractious, violent, bawdy, interesting place. But there was a personal attachment that people felt to the institution. People were angry with me for writing the book because they thought I had betrayed Salomon Brothers. The Wall Street that I walked back into to do The Big Short, it wouldn't occur to anyone that you could betray your Wall Street firm because there isn't that relationship at the heart. The relationship doesn't exist anymore. Everybody is a free agent. There's no sense of loyalty to an institution or a cause greater than yourself or all that stuff. And so what I learned was just how purely financial and commercial the place had become, and how denuded of. Essentially, what it was denuded of is the partnership sentiment. There was the residue of the partnership sentiment that was still hovering around Salomon Brothers when I got there, because it had been a partnership not that long ago. And that had been completely replaced by this new antiseptic, raw financial relationship. And that it was curious to see that people could function in that environment and feel like that was a satisfying thing to be doing with their lives.
A lot of people would say the most jaded, most cynical out there would say that there never ever was a golden age of investment banking, even when the firms were privately held. Right. It was all partners' capital inside. You agree with that?
Well, golden age might be a bit strong, but I think there were much saner structures.
The incentives were organized.
The incentives were organized much more properly. The rights incentive now is the hedge fund incentive. I mean, there are things that are screwed up about it, but typically the person who runs the hedge fund has all his money in his own hedge fund. And that's kind of how it's got to be. And he's on the hook for losses. The problem now is there's no long-term greed. It's all short-term greed. There's no it's not institution building or career building. It's quick kills. And so I do think that aspect of the business, that approach to finance, is a healthier, more golden age-like approach than what we have now. But you know, I'm not arguing that investment banks were ever perfect institutions. I mean, that's silly. I'm just saying that there's a smarter way to organize them.
Did you learn anything about Wall Street that you didn't know before in the course of reporting this book?
Yes, I did. I mean, if I hadn't learned a lot, I wouldn't have been interested in doing it. But I learned first about investing. It was very interesting to me to see just how how personal investing decisions can be. Just how in the end a lot of it comes back to who you are as a person. That you're guided by all sorts of things that I wouldn't have thought would have informed investment decisions. So just how human the financial markets were on the buy side was really interesting to me. There were several layers to the interest, but I can remember the first thing that grabbed me was I was shocked that these big firms that used to essentially be the smart money at the poker table had become the dumb money. And I was really curious how that had happened. I was curious, you know, I'd watched them change over the years and adapt to the world in ways that enable people to continue to get paid large sums of money in them. I mean, the outrageous behavior that I described in Liar's Poker, that didn't exist on it. I mean, the places got much more corporate, much more sanitized, all in the service of preserving the paychecks.
Next, Wall Street's subprime strategy finds a new home, overseas. The story of toxic derivatives didn't end with subprime mortgages. It's still unfolding today, in Greece.
The parallel gets even more elaborate because Goldman Sachs appears to advise the Greek government on how to disguise its level of indebtedness. So it feels as if Wall Street went into entire countries and persuaded them to take out subprime mortgage loans, you know, in effect. Or help them, enable them in taking out of subprime mortgage loans. Yes, we're living through this period where we are reckoning with the real consequences of financial engineering, and that financial engineering gone wrong. And the very small bore version of this was the financial engineering that enabled some poor schmuck in Chico, California, who had no income to buy $1 million house, and the big version of this is Greece.
To what degree should we point the finger at derivatives? Would any of this have happened if derivative contracts did not offer unlimited opportunities to take risk?
I have a friend who says derivatives are like guns. It's not. You know, guns don't kill people. People do. It's not the derivatives. It's the way people use them, and that is true. It's true that in better hands, there's no reason derivatives by themselves would cause problems. Derivatives are just ways of carving up the risk and redistributing it. It's also true that there is no way the misallocation of capital that occurred in the last few years would have occurred without derivatives. That you need the only way it happens is it's so complicated people can't understand it. That and so they were a necessary ingredient to this catastrophe.
But not single-handedly responsible.
Not single-handedly responsible. So I do think that more generally, not just derivatives, but financial innovation now needs to be regarded with skepticism. That we have come through an age where people just assume that anything that was invented on Wall Street must be good for the rest of the society because someone was making money from it. That all innovation led to greater efficiency. We can now see examples of innovation that led to greater inefficiency. So the question is, how do you parse this innovation and decide what's good and what's bad? It was insane that credit default swaps were not regulated as insurance, and that they aren't. It's insane that they're not, that everything that's, every new security that's created is not traded on screens with a clearinghouse so people can see what the prices should be. The problem is, it's totally hidden, that nobody knows. People can tell you who owns the subprime mortgage loans. They can't tell you who's on the other side of the credit default swaps. No one knows which firms are on the wrong side of this bet. There's no exchange. The bets are left. They're private transactions between consenting adults, and no one knows how much of it there is. This creates uncertainty. If you want to know why the panic happened in 2008, it was because no one knew who had what losses. And the reason no one knew who had what losses is there were all these private transactions of enormous size, enormous and indeterminate size, that were undisclosed.
It wasn't so long ago that Wall Street was a hidden world where what traders bought and sold didn't matter to the rest of us. Not anymore. When we come back, Michael Lewis explains why. Welcome back. Michael Lewis started his career at Salomon Brothers in the 1980s. I wanted to know, 25 years later, how did Wall Street become so dangerous?
I think the seeds of this catastrophe go back to the 80s, and that the source of a lot of the problems are people's incentives being screwed up. It's not right, or certainly not satisfying to say, oh, Wall Street's just greedy, got too greedy, and that was the problem. Wall Street's always greedy. People who go to work on Wall Street are greedy. That's why they go to Wall Street. They don't go to Wall Street because they have a calling in finance. I mean, a handful of people do, but most part, people go there because that's where the money is. They want money. You're not going to change that. What changes is are the rules that channel the greed, the system that channels the greed. And the greed came to be channeled in very short-term ways. So people became very short-term greedy. Greedy for the next quarter, greedy for the next bonus, rather than greedy for a long and lucrative career. What caused that? Firms ceasing to be partnerships is the beginning of it. That a Wall Street firm that is investing its own money, the people inside it, it's their money that's at stake, are going to behave very differently from people who are a public corporation who are using shareholders' money. No partnership would have ever allowed itself to own billions of dollars of AAA-rated CDOs backed by subprime. Just wouldn't have happened because they would have scrutinized it in a different way. Nobody will say that on Wall Street or say that's true. They'll say we behave just as we would as if it was our own money, but they don't. And nor would you expect them to. People are very, it's amazing how powerful incentives are. Two, the business got intellectualized in the 1980s. The proximate cause of the intellectualization was the Black-Scholes option pricing model, but just generally it got more complicated, and so as it got more complicated, it got harder and harder for normal people to understand it, and easier for smart people to persuade dumb people to do things they shouldn't do, and easier for smart traders to disguise what they were doing from their bosses because it's so complicated. That was absolutely necessary. One of the signature traits of this crisis is that the people on the top of the firms clearly didn't know what their firms were doing, that they were buffaloed by people underneath them. And they all feel betrayed by their employees when they're speaking privately about them. But this is why they could be, because the business got too complicated for the people who ran them. Finally, and this is a really, really big one, and related to the other two, the relationship between Wall Street and its customers. The legitimate business of Wall Street is to allocate capital. The traditional businesses on Wall Street, the traditional capital allocation businesses, have gotten less and less profitable. All these new markets, these financial innovation, is a response in part to Wall Street's need for profits. And profits drying up in, say, old-fashioned stockbroking, because you can now go on the internet and buy a stock for and pay a tiny commission rather than call your guy at Merrill Lynch and pay a fat one. Wall Street, if you look at how firms make their money, especially if you've been inside one of them, you realize that increasingly, especially in the bond markets, where more of the profits are than in the stock markets. Wall Street has come to increasingly trade against its customers rather than on their behalf. It's acting not as an intermediary, but as essentially as a big proprietary trading fund that is using its customers to get itself out of the positions it doesn't want to be in, to take the stupid side of a smart trade they want to do, so on and so forth. There is a poisonous interface between these big firms and their customers in the bond market, and everybody now takes it for granted. It shocked me when I saw it in 1987, 87, but it's now just normal. It's thought to be normal, and that is the minute you're starting to think the way I make money is exploiting the idiocy of my customers is the minute you start creating securities that are designed to explode that you could be on the other side of. The minute you're not thinking, you're thinking less like a handmaiden to productive enterprise and a useful allocator of capital. You're becoming just you're becoming the jerk in the zero-sum game, and they've become the jerks in the zero-sum game. So you back away from it all, and you say, look at what these people did, and the shocking thing is what they did was legal. And you say, how do you change the rules? What do you do here? One of the things you obviously do is you have to destroy this notion that it's okay to trade against your customers. You have to say, maybe what you say is you can be a firm like Schwab that has customers but you don't trade in anything for yourself, or you can be a hedge fund, but you can't be both. Because the minute you start to trade against the customers is the minute you start designing things that aren't good for the customers. And the minute you start designing things that aren't good for the customers, you start designing CDOs filled with subprime mortgage bonds. You start to misallocate capital. You're trying to misallocate capital, and that's crazy. I mean, it's insane, but it is the normal on Wall Street. And so breaking it up is, as you can see, changing it is going to be a violent act because it's become so assumed. It's so deeply embedded as the assumption of this is how the business is.
Want to know what gets Michael Lewis really worked up?
It's outrageous. If the markets had been allowed to function, if the government had not stepped in to rescue these firms, they'd all be out of business, all of them.
I'm getting a sense of Michael Lewis right now and what he thinks, and there's quite a bit of you in the epilogue to this book. You talk about the fantastic handouts given to the TARP recipients, how they were unnaturally selected for survival, and how it was shocking for the Fed to buy mortgage-backed securities. Are you personally outraged?
Yes, because it's outrageous. Absolutely. You know, look, they are. If the markets had been allowed to function, if the government had not stepped in to rescue these firms, they'd all be out of business. All of them. They're all failed. They're different degrees of idiocy. Maybe Goldman Sachs doesn't fail because it has lots of subprime mortgage bonds on its books. It fails because it's got credit default swaps with people who do. But nevertheless, it fails because they are the position they occupy in the financial system. They can't be allowed to fail. I think that all right, you can forgive that step. I can forgive. I can completely understand. I can understand the way how the decisions that were made in the midst of the crisis were necessarily self-contradictory, ad hoc, hard to understand in retrospect, all the rest. But now we're out of that. What I find outrageous is that the people who were in positions of influence and power when the crisis occurred were by definition people who didn't see it coming. They were by definition ignorant of what was going on right under their noses, and that there's been so little change in that regime is a little outrageous to me. I think it's outrageous that essentially the U.S. government took the position, unlike, say, the U.K. government, that these firms were so central to our way of life that not only could we not let them fail, but we can't even suggest their creditors take a hit. That essentially they're failed institutions that we need to prop up, so we are going to gift them money until they get out of their problems, which they appear to be doing now. That's what we've done, though. We've gifted them money. In the beginning, we gifted them money in a very overt ways, direct investment in the firms or buying their securities or whatever at inflated prices or whatever, those obvious ways. But now their ability to tap the Fed for money at 0% and reinvest the money in agency bonds and take the spread is a gift. So it's outrageous that they're essentially being gifted out of their problems, and that their view is that their employees deserve a large chunk of the rewards of those gifts. I think that, but it's outrageous. On the other hand, it's understandable because they have a way of life that has existed for 30 years on Wall Street. It's very hard to change people's habits, especially if they don't have to change. And they've proved that they don't have to change. I think that the end result of this, however, is just to stoke the political anger that is going to change the system. So I think that in the end, in a weird way, the behavior of the Wall Street firms currently is the best friend that reform has, because they're not doing a very good job of disguising their interest in the rest of the world.
The firms that survive may be even stronger now than they were before, and a whole lot of the people, the traders, for example, who lost their jobs, are back employed by the firms that survived. So where is the justice?
It's not over. I mean, we're living through this big transition right now, I think. But Wall Street has changed dramatically, and Wall Street's relationship to the rest of the world has changed dramatically, and the way people view Wall Street has changed dramatically. These firms have gone from being unquestioned masters of the universe, an unquestioned kind of upper class that everyone aspired to being essentially enemies of the people inside the last 2 years. I mean, they do have a lot of political influence, and there is natural resistance and impediment to changing the rules of their road. But there is also, on the other side of that, enormous anger and cynicism that is going to find a political expression. And you can't expect democracy to move as quickly as finance. Financial markets panic. They change very rapidly. Democracy moves very slowly. In 1929, the markets collapsed. It wasn't until 1933 that Glass-Steagall was introduced. It took several years to have proper hearings in Congress. The reason for that is that the engine of a democratic change is elections, and elections don't happen every day.
There's something about Michael Lewis that sets him apart from other writers. When we come back, the author tries to handicap his own success. What is it about Michael Lewis that makes him different? What's the thread he followed? From Wall Street to Silicon Valley to baseball and football and back to Wall Street again. I wanted to know.
My own explanation for why I've always been so interested in this. I mean, I'm interested in why anybody would pay me a lot of money to advise people to what to do with their money. I mean, that was the beginning of Liar's Poker. I think it's that I grew up in a city, in a culture, New Orleans, that was had experienced enormous status collapse, and it was experiencing it. And things that I cherished and valued were no longer valued, or being less and less valued by the world. And things that made for a happy life were less and less valued in the world. And I think that that as I enter adulthood, when I'm in my late teens, early 20s, I am perplexed by what people think is important and valuable. And so I'm probably drawn to that subject in part for that reason. But other than that, I I don't have a self-conscious obsession with the subject.
If you had to handicap it, what would you say has been the key to your success?
Sloth. Then now let me tell you, I mean, this is not completely a joke. Indolence, rather, more than sloth. That I think that the fact that I'm inherently a little lazy, and you may not believe this, but if you just ask my wife, she will tell you, that it means that I have to be really roused to do anything. I have to be really interested. I don't write a book because I need to write a book, because I really don't need to write a book. I write a book because I'm really interested in it. So that really helps. It really helps that it's not exactly a lack of ambition, but a kind of I'd rather be laying in bed reading a book or watching TV or playing with my kids, or that it helps to have to be roused to action rather than just be always ready for action. I think it's helped me that I have a pretty low threshold of boredom. That if I'm not humored and interested by it, that I just drop it.
Were you surprised by the commercial success of The Blind Side, both as a book and now as an Oscar-winning movie?
I was so taken with the story that I couldn't believe it took so long for the movie industry to be interested in it. And it did. And it only got made accidentally. It got made because of the intercession of Fred Smith, the head of FedEx, has a movie company. He knew the story personally. He lives in Memphis. And he made it happen, I think, is what happened. So I can't say, I wish I could say I was really surprised. I'll say this about it, that when I wrote it, it was very different from anything I'd written. And I was surprised my publisher didn't give me more grief about writing it. They were wonderful about it, and they probably shouldn't have been. And we found it, in the first instance, a hard book to sell. It did not sell well as a hardback. It's sold well now because of the movie. But if anything, I was surprised I didn't do a better job selling it when it came out. I thought it would do better than it did.
Well, nobody expected Michael Lewis to write a tearjerker.
Me neither, and I still cry when I see it. How does that work? But it's also very fun. I mean, the movie may be a little less so, but there's a lot of humor. It's a pretty funny story. At the same time, it's funny and
tragicomic in a way.
Well, but this is actually, I think, something that's basically universally true. Is that in some weird way, all emotions are the same. The presence of humor makes it even easier to evoke tears. That crying and laughing, you're feeling something. And this is a story in which you felt so much. Which is why I thought it would be a movie, because Hollywood's naturally attracted to that sort of story. But I felt so much of it when I was writing it.
This team is your family, Michael. When you look at him...
With the Oscar success of his book, The Blind Side, Hollywood beckons. Coming up, Michael Lewis and I talk about his other movie prospects. Michael Lewis wrote Liar's Poker, Moneyball, and The Blind Side. More now from our conversation about his newest book.
You hope The Big Short gets made into a movie?
Well, it got bought. Paramount and Brad Pitt bought it. This is what I've learned about the movie business so far. It is pointless to hope it does anything, because you have no control over it. I'm not even sure it has control over itself. So it's like this raving lunatic wandering the street. You don't want to hope things for it, because your hopes are just going to be dashed. I try to keep my emotions detached from it and not get too worked up about it. Of course, it's better if it gets made into a movie than not, because even if it's made into a crappy movie, more people will read the book. So sure, and I actually don't care whether it's a crappy movie. I mean, I'd like it to be, of course, it's better if it's a good movie than a crappy movie, but I'd rather make a crappy movie than no movie at all, because it drives traffic to the book.
If it did get made into a movie, have you given any thought to whom you'd like to see play certain characters?
I have. I think Philip Seymour Hoffman should play Steve Eisman. That he's so perfect for it that it's just not true. I think Matt Damon should play Michael Berry. They even look a little alike. But Matt Damon, I think he could do Asperger's well, and he hasn't done it yet. And everybody should do Asperger's once as a movie
At least
star,
once in your
right?
career.
Right. Then there are these three essentially kids that they're in their early 30s, but they're sort of young men with a Schwab account. And I think I would cast them out of the Judd Apatow universe of actors.
Seth Rogen?
Yeah, Seth Rogen and Seth Rogen and the Superbad guy, and it's Jonah Hill, and yeah, that I would cast essentially comic actors in that role.
Would you want to go back to writing about things that people never saw before, people never heard of before,
Right.
and as a result gave your audience kind of a strategic roadmap for what was going to happen?
Yes. It bothered me about The Big Short that it wasn't the greatest financial crisis in the history of the world was not a secret. I would like it to have been a secret. But on the other hand, it's nice that the subject is obviously important. I can't generalize about where I'm going to find a story. I mean, it just so happened that I found what I thought was a really riveting story inside this big event. So it wasn't the whole event, it was this very narrow story inside the event. And having said that, it still bothers me a little bit that the event's so obvious. I mean, any idiot can write a book about the financial crisis. So I would like to, all things being equal, I'd rather nobody have ever heard what I'm writing about, because it's there's a freshness to that, and you feel like you can, you can invent the world in some way that you can't do if everybody, your reader comes with so much baggage to a story about the financial crisis that they don't bring to a story about a poor boy no one's ever heard of. So all things being
team nobody was paying attention.
That's right. So all things being equal, I'd rather farm land that's not being farmed. But all things are never equal. And I actually don't know exactly what I'm going to do next.
Michael Lewis started his latest book, The Big Short, with a mixture of fascination, curiosity, and awe. How could so few people have spotted the financial meltdown and made so much money doing it? He walked away with a sense of outrage and a conviction that something on Wall Street has to change, or we'll surely end up with another crisis. I'm Erik Schatzker. Thanks for watching.